What's going on, everybody? Little Fish Investor here with another video, and today I'm going to be showing you guys a great tool that you guys can use to help implied volatility, to help you source out those stocks that you're trying to collect a great premium on. So as you see right here, I have it pulled up. It's called bar chart. If you just Google bar chart options, it comes up #1 on the Google search engine. You click on that. Then it'll bring you to the site. You'll click on options, and then you'll expand the list. So unless you have the premium membership on there, you won't get live updates on where everything is currently at. But the free one kind of gives you a rough basis. And for this video, this is a perfect example to kind of break it down for what we want on there, because it gets you close enough and gives you a rough idea, and it helps break down the stocks that roughly do have high implied volatility, so that way you don't have to source through and comb through thousands of stocks to try to find that premium that you're looking for. So essentially, we'll look at our first ticker symbol here, CLOV. What we're going to look for is this little thing right here called IV. That's our implied volatility. It is at 331% implied volatility. So why is this good? Because typically the higher the implied volatility, the higher the premium is typically. So what implied volatility is going to be used to determine the massive movements between either the stock going up or down with it. So they're expecting a rapid movement with the stock to either go up or down in a short period of time, which is good for options trading, for that premium on there. Because remember, whether it goes up or down, when it comes to selling calls or puts, we don't care. We're not married to the stock. It's just all depending on the premium that you want and where you feel comfortable selling your shares at if you were to get assigned. So we have CLOV pulled up. We're going to go here to Robinhood, which we're under the trading on there. We're under sell call and the for this stock expiration date of June 18th. So we're going to say perfect scenario that I bought this at $21 even on there, and I did a sell call for June 18th, and I set the strike price for $22 on there. What that means is that I am going to get a premium of $485 for writing that option, and I'm basically agreeing that if my stock of CLOV were to hit the strike price of $22 or higher by June 18th, I would have to sell my shares at $22 on there. I would collect that capital gains from when I bought it to that $22 on there, and I also keep that premium of that $480 on there as well too. And as we broke this down here, we see that our implied volatility was around that 370, and it's gone up to around a 380 right now. One thing also to keep in mind is that delta right there. So typically the higher implied volatility and the closer the share price is to that strike price, the higher the delta is going to be. Now, we use delta in our favor for this reason. Typically, the lower the delta, the better it is in our favor when we're coming to sell the shares of stocks, because the delta is more a tool for a buyer. The higher the delta is, the more chance for the buyer to succeed. So right now we're looking at a delta of 0.60, so that is a 60% chance that this will meet the $22 strike price by that expiration date, with a high chance for us to get assigned these stocks, and we would have to sell our shares. So it only gives us a 40% chance of us not getting assigned. But if I were to do this, I wouldn't care if I got assigned anyways, because if I did, I would sell those shares. I would still get that premium of the 480, and I would also get that capital gains right back in my buying power for selling this stock. So great tool, guys, to help find implied volatility. We'll use another example as well too. We got EH over here, EHang, which I found from that site as well too. Huge high implied volatility has gone up since I pulled it up last to 200. So right now this is going to cost me $3,900 essentially to buy 100 shares for it. And then if I feel comfortable, let's just say this is my strike price of $55. Like if I don't feel comfortable selling this until it hits 55, I would get instantly $128 on there. So rule of thumb to keep in mind, most likely the higher the implied volatility, the higher the stock is trading at, typically has the factors of the high premium, but it has to have a great implied volatility to really have a great premium on there. Even if you were to get into high stocks, I know stocks that are trading at $500 a share on there, and you don't get anything for the premium, and that would cost you around $50,000 to be able to even do a call option on. But is it really worth the premium on there if it doesn't have that high implied volatility? So anyways, guys, again, this is the site bar chart. If you type it in Google, bar chart options, this helps you for a tool to help you source out the implied volatility on stocks, to help you look for that sweet premium, to help you build that portfolio and that passive income. So that's it for this video, guys. If you like this content, please smash that like button, subscribe if you want more videos like this, and I'll see you in the next one.